Happy New Year to you, Valerie. How you doing?
I'm great. Super happy to be back here with all of our lovely listeners. I'm Valerie Escobar, Certified Financial Planner with Mariner Wealth Advisors, also joined by Mike MacKelvie, Certified Financial Planner as well. You are listening to Your Life Simplified, and today we are going to do a novel, wonderful thing. We're going to have a fun list of resolutions to start off your new year.
Yes.
Mike, what do you have on your list of personal resolutions?
Yes, this is something that nobody does. We proposed this idea. We know it sounded crazy, but the idea of resolutions.
Are you going to join a gym and never go?
No, I have too many gym memberships right now. Like, I don't know why. And I'm not like some fitness nut. I don't know why, but I ended up with like 3 or 4.
Right.
But no, personally, I got some personal resolutions, but I think we're here to talk about some financial resolutions you might want to consider on the opposite end, maybe for your financial plan, right? So,
Mm-hmm.
I got one just to start with here, and that is
Yeah.
just having a plan. And I think that really begins with defining what it is that you want, i.e., goals. Goal setting is, really I think an action that gets tossed around and really abused nowadays. How important it is, though, still remains. Defining what it is that you want, defining what it is that you really desire, whether it's financial planning, whether it's, funding some educational goal for your kids, whatever that might be, it's incredibly important, obviously, from a motivation standpoint. So I think, again, typically a lot of people tie goal planning to the beginning of the year for an understandable reason. And what comes with that, Valerie, is the budget, right? How much is also going out? Where are your expenditures? And again, I hate to bring up the word budget, the B word, because, well, we just know that, from like a behavioral standpoint, it's very difficult to follow through with actually making a budget and sticking to one. But still, January 1st provides a good opportunity to really revisit the expenses, not so much from like, hey, are we just breaking even, or, hey, do we have enough money? But getting more purposeful with maybe where your monies are headed and not just all the waste. In a capitalistic society, it's very easy to pile up a ton of subscriptions nowadays, a ton of different expenses. January 1st provides a good opportunity to just revisit things and say, okay, hey, is my money flowing where I want it to flow, right?
Yeah. And Mike, I would add to that one resolution is to purposely save up for an expense. And so you're saying, okay, I'm going to go to, Croatia this summer. And so it is going to cost me X amount of dollars, and I will save up for it and have the money before I go. I know a lot of us sort of fall into my cash flow generally covers things and I'll make up for it after the fact. But purposefully saving up for a given goal, I will add to
Yes.
that one as well.
Yeah. Yeah. And what about, 401ks, HSAs, Valerie?
Yeah. So this is a great time of year to go ahead and up your contribution amounts. Usually year end, we get, hopefully, a cost of living adjustment raise. That's usually a good number to go ahead and throw into your 401k. Maybe it'll play into your budget a little bit. So the goal is certainly to max it out. That's what I would suggest for everybody as a good baseline. Your HSA, health savings account, that is tied to your high deductible
If
insurance
you have
plan.
one. Yeah.
Yep. So you have to make sure you have one of those. And when you do, then you're eligible for an HSA. I don't know if you knew this, Mike, but that has like a triple impact.
Triple tax savings.
Triple tax savings. That's right. Yeah.
Yeah.
So always a good place. Tell me what you like about triple tax savings.
It's better than double and single. Very
Agreed.
good.
It is.
Yeah.
It is. But yeah,
It's
put as much in
thrice
there.
is good.
Yeah. And I love, it to the extent possible. Pay your health expenses out of pocket, and leave the HSA alone to grow tax-free for tax-free distribution later on.
Yes. Yes. And potentially, if you are education minded for your children, consider opening a 529 plan. Okay. This is so incredibly easy. Again, it's just one of those things that's very easy to put off, though. And we know that education has obviously become increasingly more expensive to where I have never met anybody that's oversaved
Hmm.
for higher education. I don't know if you have. Sometimes we have the fear of tying up the monies in 529s because they have to use for qualified higher education expenses. I have yet to meet the individual, though I know that they probably exist, that has truly oversaved in a 529. You can always change the beneficiary of your 529. So if you save into one, maybe one kid gets a scholarship or doesn't go, you can change the beneficiary. So something to consider here, beginning of the year, opening a 529 for some beneficiary. It might be a grandchild, might be your child, might be a friend's child, and you just want to get it moving for them, and that's your gift. That's actually what I did for my brother. So that's something to consider. Now, maxing out the IRAs and maxing out your own personal retirement accounts earlier in the year. You can also consider doing a backdoor Roth IRA earlier on in the year. The idea here is, and again, past performance is not indicative of future returns, but if you do it earlier on the year, you give yourself more of a compound effect runway because you're doing it sooner. So if you know that you can put money into the IRA, if you know that you're considering converting or doing a backdoor Roth IRA, whatever it might be, doing it earlier in the year to give yourself more runway for more of a compound effect there, Valerie.
Mm-hmm. Yep. No, and I think that really it's a good time to evaluate. Well, how am I invested in those IRAs, those Roth IRAs? Depending on what your financial plan is, if you are, your risk tolerance is very high, we'll say, for example, the Roth IRA is usually a really good place to put lots of growthy assets because that'll probably be the last money that you ever touch. So it has tons of
Right.
time to be able to grow. IRAs, on the other hand, sometimes if your financial plan is such that the required minimum distributions from that IRA are going to be something that frankly is more than you need or want, then maybe you put some fixed income in there. The savings was on the front end because you got the tax deduction, but on the back end, it's not quite as important or as valuable for it to grow. So, but
Yep.
throughout your entire plan, just reevaluating, how did I feel during the last stock market crash? Was
Right.
I really as risk loving as I thought I was?
Yeah. Yeah. Um, I think the answer to that is probably not. Yeah.
Yes,
Especially
very
if
rare.
you're,
I would say if you during that time that your first thought was, I should put more money to work because this is a good
yeah.
opportunity, then you probably do have the right to risk tolerance. But if
I
you
always, yeah, I always think of that
cringe,
line from Mike Tyson about like everybody's got a plan until they get punched in the face, right? It's so true when it comes to our finances, our
yeah,
money management, right? I have sat down in so many meetings and seen people that say, "Yeah, I understand the market goes up in the long run," and then as soon as they see some significant decline and they have some money to lose, things change a little bit.
yeah,
Behavior maybe gets the best of them. So, additionally, from an estate planning and review standpoint, so completing your estate plan, maybe considering reviewing your life insurance needs in the process. Estate planning, again, nobody likes to plan their own mortality. So it's probably something that needs updated. I would be willing to bet for most people, if they have any plan at all, beyond just the state's plan. You always have some plans, just a question of whose. So,
you control it
um,
or not is another question.
yeah. So I would say, updating the estate plan, just setting a time, just, whether you're watching this right now, just reaching out to whoever it is that you plan on working with, or reaching out to somebody that might connect you to an estate planning attorney, just to get that process started. It's so easy to kick down the road. Again,
Mhm.
probably needs some updating. I would also check in the process of that, reviewing your life insurance needs. Something else that we're probably not waking up on a Saturday or on January 1st saying, wow, I really want to spend today figuring out, do I have a deficiency in my life insurance coverage? So again, it's easy to kick down the road, it's easy to put off, but chances are when you do the math on your life insurance coverage need, you are undercovered. Most people are. So take a look at what your life insurance need is and consider maybe getting something to cover that.
Right. And there's term insurance that can be pretty cheap. And so it may not be that financially painful. It's kind of just a thing that you just don't want to do. So do it.
Yeah.
Look at that estate plan. And with the estate plan, generally most people are creating trusts, even just a revocable trust. So that means one that's not hard and fast forever. You can make changes to it while you're alive if you're the grantor, if you're the one putting things in that trust. It's only as good as it being funded. So you went and you created this fabulous document. you need to now go to your bank or go to your investment advisor and make sure that you have your taxable accounts perhaps that are titled to the name of the trust, or that you have the trust as a beneficiary to an IRA or to individual accounts, or whatever it is that you do. Work with your attorney, of course, and your financial planner, making sure that you have things updated, titled correctly, and beneficiaries that are correct. Many times have come across people that have, ex-wives, children that they have disinherited, things like
My
that.
brother had his ex-girlfriend on there. Yeah.
Oh, yeah. Don't list your girlfriend on,
Yeah.
or
Yeah.
unless that's really something you want to do.
Yeah. You don't want to do that. You don't want to do that.
That's a different conversation, but yes.
Yeah. Yeah. So revisiting the estate plan, but also revisiting gifting strategies.
Mhm.
So consider lifetime exemptions, consider vehicles for charitable purposes, giving via a donor advised fund, private foundations, charitable trust, whatever it might be. I think revisiting that desire to be charitable and really that perspective of, earning to give, and not
Mhm.
just, hey, I'll close it out when I pass away, but how you're going to be purposeful with your money. Maybe as you're redoing the budget, you say, okay, hey, a few of these subscriptions I don't need. So I'm going to take the monies that I was placing towards those subscriptions towards some charitable cause. And I think there's a lot of power in doing that. And it's very similar to, as you age and you start to give more gifts come holiday season, whatever it might be, and you realize like, hey, this actually feels pretty good to see someone on the other end receiving this gift. And I'm not virtue signaling by any stance here. I think we can all appreciate that feeling. And I think earning to give is something you should consider here.
For sure.
So,
And I've noticed a lot of clients that we're running through their financial plan, and they say, it is important to me to leave a big or a inheritance to my kids. But then they're realizing, what would be even more fun is giving their inheritance to them while I'm still alive. So
yeah.
again, playing into that gifting, we do have to be very strategic about it. As you notice, there's gifting limits. They go up usually with inflation. And so if there's a married couple, you can both gift, each of you to one single person and kind of spread that around. So
Yeah.
being really reevaluating that and being strategic is super important.
Definitely. And what about gifting appreciated stock, or, gifting something to a 529 earlier on the year?
Yeah, for sure. Yeah. So that is really getting a double, I think, more money, more bang for your buck if you're gifting appreciated stock. Let's say you wanted to give $10,000, but you have $20,000 of a stock that you originally paid $10,000 for. So now you're able to give the full 20,000. You didn't actually, you only invested 10,000, and now you also have the benefit of not having to pay that capital gains tax. So making a bigger, contribution would be something that usually sits well with most people. With those 529s, they are, of course, or they are subject to the gifting limits, but we do have the advantage of being able to do a front loading strategy. So you can gift 5 years worth of gifting amounts to a 529. So, I mean, that is pretty sizable. I think in 2023, what will that be? 84,000, something like that. If it was a couple, there's a lot to be given if you can. So talk to your advisor, come up with, if your CPA is somebody who likes to be strategic and forward plan, then that could be somebody else that could also be a resource.
Yeah. And I think that's what it comes down to, is just being proactive.
Mm-hmm.
And you get a chance to reset here. And as much as, people do make fun of resolutions, I think they exist for a reason. There's nothing wrong with wanting to get better. There's nothing wrong in wanting to improve your situation. And hopefully you found this video helpful. Again, we thought it would be good just to go through just some New Year's resolutions financially to consider at the beginning of the year. My name is Michael MacKelvie. I was joined by Valerie Escobar. This is Your Life Simplified. And if you're listening on Apple Podcasts, Spotify, YouTube, wherever you might be listening, make sure to hit that subscribe button so you don't miss out on any more industry insights from industry professionals here at Mariner Wealth Advisors. You guys have a good start to your new year.
See you next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Because the administration of an HSA is a taxpayer responsibility, you are strongly encouraged to consult your tax advisor before opening an HSA. You are encouraged to review information available from the Internal Revenue Service, also IRS, for taxpayers, which can be found on the IRS website at irs.gov. Before initiating a Roth IRA conversion, please consult with a financial or tax professional and ensure you consider all your available options, including applicable taxes, fees, and features. A distribution from a Roth IRA is tax-free and penalty-free, providing the 5-year aging requirement has been satisfied and one of the following conditions is met: age 59 and a half, disability, qualified first-time home purchase, or death. Investing in securities involves risk of loss, including loss of principal, that clients should be prepared to bear. Strategies or investments discussed may fluctuate in price or value. Past performance is not indicative of future results. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.